Right now, Opendoor Technologies, ticker symbol OPEN, is trading at $7.19 per share, down 2.41% for the day. That's a drop of 18 cents in the first hour of trading. While on the surface this looks like another predictable dip for a real estate tech company in a nervous market, what's happening underneath is far more interesting. This isn't just about today's mortgage rate headlines. It's about a subtle but critical divergence between how institutional money is positioning itself versus the story that most retail investors are being told about the future of iBuying. The common belief is that Opendoor is a simple proxy for the housing market. When the Federal Reserve hints at holding rates higher for longer, stocks like Opendoor are expected to fall. And when there's a whisper of a pivot, they are expected to rally. It's viewed as a straightforward, high-leverage bet on the direction of real estate prices. But clinging to that narrative is becoming a costly mistake. The reality is far more complex. The true battle for Opendoor's future isn't being fought on the stage of macroeconomic policy, but deep within its own data science departments. The real story is whether its proprietary valuation models can outmaneuver a volatile market with enough precision to not only survive, but fundamentally reshape a multi-trillion-dollar industry. Looking at today's intraday action, the stock opened at $7.24 and even briefly pushed to a high of $7.28 before sellers stepped in with force, driving it down to a session low of $7.02. That quick rejection of the morning's high suggests that any initial optimism was met with significant institutional selling pressure. The volume, while not extraordinary, is steady, indicating a consistent flow of sell orders rather than a single panic-driven event. This pattern often signals that larger funds are methodically trimming their positions, perhaps rotating out of high-beta tech and into safer assets ahead of upcoming economic data. This isn't just a reaction to general market sentiment. It's a calculated move reflecting a deeper skepticism about the company's ability to navigate the current housing environment. The spread between its high and low today already exceeds 3.5%, showcasing the kind of volatility that has become characteristic of the stock. When you compare this movement to the broader Nasdaq, which is only down fractionally, it becomes clear that this is a company-specific pressure, not just a case of the tide going out for all tech stocks. Investors are singling out companies with high sensitivity to capital costs and consumer discretionary spending, and Opendoor sits squarely at that intersection. Before we go further, it's essential to understand exactly what Opendoor does. The company is a pioneer of the iBuyer or instant buyer business model. In simple terms, they provide a platform where a homeowner can request a cash offer for their property directly from Opendoor. If the seller accepts, Opendoor buys the house, performs light repairs and maintenance, and then lists it for sale on the open market. Their revenue comes from a service fee, typically around 5%, which is comparable to a traditional agent's commission, and any profit they make on the eventual sale of the home, the spread between their purchase price and the final sale price. The entire value proposition is built on speed and convenience for the seller, removing the uncertainty of showings, negotiations, and deals falling through. This model requires immense capital to hold billions of dollars in housing inventory on its balance sheet, and its profitability is acutely dependent on its ability to accurately predict short-term home price movements. When they get it right, the model is incredibly efficient. When they get it wrong, the financial consequences can be severe, as seen during past market downturns when the company had to write down the value of its inventory. This inherent risk has made Opendoor a prime target for short sellers. The current short interest in the stock is a significant figure, floating around 19% of the public float. To put that in perspective, nearly 1 out of every 5 shares available for trading is being used to bet against the company. The short thesis is straightforward and compelling. They are betting that in a flat or declining housing market, Opendoor's business model is fundamentally broken. They argue that its algorithms, no matter how sophisticated, cannot defy the gravity of falling home prices and rising holding costs. Short sellers believe that Opendoor is essentially a house flipper operating at a massive scale, and that its balance sheet is a ticking time bomb of depreciating assets. They point to the company's cash burn and past inventory write-downs as evidence that the model is not sustainable through a full real estate cycle. What's your take on the rising short interest? Smart money or manipulation? Let me know your thoughts below. For investors, it's crucial to know how to track this activity. You can find basic short interest data on platforms like Yahoo Finance, but for more granular details like the cost to borrow shares, a key indicator of short seller demand, you'll need services like Fintel or Ortex. A sharp increase in the borrow rate can signal that short sellers are becoming more aggressive and are willing to pay a premium to place their bets, which can sometimes foreshadow a significant downward move in the stock. Conversely, an extremely high borrow rate combined with a positive catalyst can create the conditions for a short squeeze. However, it's vital for retail investors to approach this situation with caution. While discussions on social media platforms may hype the potential for a short squeeze, these events are rare and notoriously difficult to predict. A squeeze requires a powerful, unexpected positive catalyst that forces short sellers to buy back their shares at a loss, creating a cascade of buying pressure. Without such a catalyst, a high short interest is simply a reflection of significant negative sentiment from well-capitalized institutional players. The actionable step for a prudent investor is not to blindly hope for a squeeze, but to understand the short thesis and evaluate its merits against the company's actual performance and strategic direction. Is management effectively managing its inventory? Are contribution margins improving? Is the company demonstrating an ability to accurately price homes even in a choppy market? The answers to these questions are far more important than the short interest percentage alone. The next earnings report will be a critical battleground where the bulls and the short sellers will see their thesis tested against hard data. Looking ahead, the path for Opendoor is defined by a clear set of catalysts and risks. The most immediate catalyst is, of course, any change in monetary policy from the Federal Reserve. A clear signal that rate hikes are over and that cuts are on the horizon would likely lead to a significant rally in the stock, as it would lower borrowing costs for consumers and reduce Opendoor's own capital costs. Another key catalyst would be a stellar earnings report that demonstrates improving unit economics, proving that the company can generate consistent profits per transaction even in a challenging environment. On the risk side, the primary threat remains a prolonged housing market downturn. If home prices were to fall significantly, the company could face substantial inventory write-downs that would erode its capital base. Competition is another factor to watch. While Zillow exited the iBuying business, other tech-enabled real estate companies are constantly innovating, and there's always the risk of a new, more efficient model emerging. Furthermore, regulatory scrutiny of the real estate industry is an ever-present risk that could impact how iBuyers operate. Comment below with your projection for the average 30-year mortgage rate by the end of next year. Ultimately, the story of Opendoor comes back to the central tension between expectation and reality. The market's expectation is that this is a simple, volatile real estate stock, beholden to the whims of the Fed. The reality is that its fate rests on the superiority of its technology and its operational discipline. If its algorithms can consistently price risk more accurately than its competitors and the market at large, it has a genuine opportunity to capture a significant share of the massive U.S. residential real estate market. If its technology provides no durable advantage, then it is, as the short sellers contend, simply a highly leveraged bet on a cyclical industry. The current stock price action, with its nervous intraday swings and heavy selling pressure, suggests that Wall Street remains deeply skeptical. The challenge for Opendoor's management is to prove, through consistent execution and transparent reporting, that their data-driven approach is not just a fair-weather advantage, but a genuine, all-weather competitive moat. For investors, the task is to look past the daily noise and focus on the underlying metrics that will ultimately validate or invalidate the company's ambitious vision.